The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for financial, legal, or tax advice. To determine which strategies or investments may be appropriate for you, consult qualified professionals prior to making decisions. Hey there, community bankers. Welcome back to the Correspondent podcast. I'm your host, Madison Caplinger, Marketing Associate for ICBB, and this is our second quarter market update. I'm joined today by our Chief Credit Officer, Stephanie Oerther, our CEO, Derek Hetherington, and the president of our affiliate, Sapphire Fiduciary Advisors, Paul Stropkay. How are you all doing today?
Very good.
Doing well, thank you.
Doing good. So we're talking about the reflecting on the second quarter today, and I'm curious on your thoughts about the state of community banks, especially compared to last quarter. I know that deposit growth has been more of an issue last quarter and all of this year, really, than I think most people remember it ever being. So, have we seen any change there? Is it up from last quarter? Is it, still kind of down?
For ICBV, which of course we are here for community banks, so their money is with us, and our deposits, are still kind of down. And I don't think we've seen this level of deposits in a long time. So um, I have actually dealt with a couple of our community bank customers that are dealing with some liquidity issues, and they've asked that maybe ICBB purchase a couple of loans from them in participation so that they could increase some liquidity at their banks. That's definitely something that's out there and available. I just got a request for that yesterday, so I'm going to take a look at it. Derek, did you have anything to add to that?
Yeah, one of the things that we kind of monitor is the overall Fed funds pool, which basically consists of the excess liquidity from all of our respondents. And we monitor where that's at on a week-to-week basis, sometimes even day-to-day, based off what we need to keep as far as a liquidity position to manage that settlement piece. And obviously, when you go back 24 months, even maybe 36 months back into the start of 2020, uh, in my banking career, I've never seen that much of an influx of liquidity into the market, which obviously would result in additional deposits being held at those community banks versus the outflow of liquidity that we've seen here in the last 6 months, which is representation of those deposits or excess deposits being held at those banks. So we're basically back on our balance sheet, and the liquidity position that we are experiencing today is pretty much in line with what we saw in 2019 prior to COVID stimulus and the money that was injected during the pandemic. So that big influx of liquidity kind of sat on the balance sheet for a couple of years. We've seen that kind of flow out. So our expectation with our banks having a tightening of liquidity and funding, obviously for the last couple of years, it hasn't been a big focus because there's been so much excess deposits sitting on their balance sheet. So that I would expect or anticipate that there's going to be a lot more demand and competition in the marketplace to try to capture deposits and to grow those liabilities. And you're also going to have non-banking competition now with where interest rates are at. They're going to be really creating a lot of competition for banks to have to pay a higher, cost of funds, which then will impact their net interest margins as well. So a lot of dynamics going on there. You have that drastic where you basically saw double the amount of liquidity that was in the market in a matter of a month with the liquidity injection we saw in 2020. And then we saw it kind of just stay there through the PPP loan program and all the different stimulus rounds and the stuff that we saw kind of coming into the market. That liquidity held for about 24 months. Then when you see inflation and some of these things that have kind of started to eat away at people's income, they've had to start utilizing more of that cash. Increasing in interest rates has caused more people to put more cash equity into the front end of projects versus just financing them at a low interest rate. So a lot of that liquidity is being basically forced back out of the economy, and we've basically seen that reset. So basically, half that liquidity or half of the liquidity that was in the market in 2020 is now gone, and we're reflective of what we saw prior to the pandemic.
And I'd add, Madison, from the publicly traded stock and bank perspective, that FHLB advances have increased, and also broker deposits. So, in the companies that are larger than the community banks served by ICBB out in the country, across the publicly traded universe, liquidity is an issue as well.
Yeah, it seems like we're going through an interesting little perfect storm right now post-pandemic in banking.
One thing to add to that too, Madison, is that when you look at how, I think the greater question is how is the liquidity impacting our respondents? I think the
Mhm.
biggest thing that we've kind of seen, and everybody has kind of seen in the headlines over the last 6 months, is the bank failures that were a direct result of poor liquidity management and asset liability management of some larger regional institutions.
Yeah.
And I think that when you have that much liquidity influx, banks are looking for ways to create yield, and when it's sucked out of the economy, if there's not proper structure and management of those assets, you have the result of basically bank failures that had absolutely no asset quality issues or capital issues. When you look at it from a call report perspective, they were as clean as could be. But when you kind of dug into it and you started looking at their asset liability management, um, the outflux of liquidity was the direct impact and the result of that failure. Um, so that's a clear indication when you have three of the largest bank failures in U.S. history occurring, and it was completely driven by market sensitivity and liquidity issues on the balance sheet for those banks. That right there is a key indication that liquidity is not available. It's being sucked out of the market. There's a lot of competition for it, and then once that happens, then that creates even more concern for the consumer. Like, how much liquidity do I want to keep in a financial institution? So, large depositors over $250,000 are putting it out in the market. So that's why you see this influx of, brokered or hot money kind of hitting banks. So there's a lot of things that we're seeing highlighted that are clear that this is not just a community bank. They're the ones being pressed. This is banking industry wide, and it's impacting banks all the way up to some of the largest institutions in the country.
Oh, yeah, for sure. And, the other side of that is, when you don't have that liquidity and that deposit, it and correct me if I'm saying anything incorrectly, but it kinda kills your loan growth because you don't have of course, you don't have the deposits to back that up, and, of course, we've got, interest rates quite a bit higher than they've been the past few years. So, I'm gonna guess that we're seeing loan growth kind of stall as well?
Well, from a participation side, not necessarily. And the reason for that is these banks are wanting to lend to their own community. And in order to do so, they need help with, the liquidity side of it. So they'll sell some of that participation loan to us so that they can actually, be able to fund their own borrowers in their own communities. So as far as the bankers bank goes, it is, we still have plenty of loans in our pipeline, and our customers seem to be lending in their own communities. But I'm not sure that it's growth. Their loan growth is not as high as it has been. I think that's settling down a little bit simply because these borrowers aren't wanting to pay those higher interest rates.
I'd add that, on the interest rate front, and in relation to what you're talking about, Stephanie, is usually higher interest rates are helpful for banks. But in this case, where a bank may have been asset sensitive and the financial model said we're going to be a lot more profitable because um, our net interest margin is going to expand with higher interest rates. What's happened is that the borrowers have said, wait a second, I've had this adjustable rate mortgage, or adjustable rate loan, rather, and it's up 400 basis points from where it was last year. I can't afford that. And so these borrowers have come back to the banks and renegotiated their loan. And if the bank wants to keep those loans on the books, they're going to have to make a concession for those borrowers. And at the same time, you've got a higher cost of funds as a result of this reduced liquidity. So it really is a perfect storm, as you mentioned, Madison.
Yeah, and just to add to the comments that Stephanie and Paul made. I think one of the things too on the loan side is you're going to see a little bit of maybe a tightening in the credit quality requirements that banks maybe were, previously maybe allowing higher exceptions for debt service coverage, maybe not shocking credits as significantly on the interest rates as what they maybe uh, probably were doing prior to 2022. So just there's going to be, I think, an overall tightening because if there is a recession, banks don't want to be putting on credits that look great today, but with a recession, this could potentially become an adverse credit, 12, 24 months from now. So on top of the liquidity crunch, banks are also going to be looking at tightening the credit underwriting and kind of their perception of what exceptions they'll be willing to accept or what level of liquidity that their borrowers need to have or what kind of debt coverage requirements they may be able to provide. And I think, especially with new development, anything that's considered to be based off of performance, and it's not a historical number that they can kind of have reassurance that this cash flow is going to be available. You're just going to see a tightening there. So I think overall, yeah, loan volume is going to drop off for two perspectives. One, there's just a tightening of liquidity, an inability for some of these projects to move forward because it's coming at a higher cost. Maybe some pullback because some of these appraisal valuations that are based off a lower cap rate during a lower interest rate are going to start to be pushed up, which is going to bring the value of some of these investments and projects down. So I think it's going to be an accumulation of several things that will result in fewer credits being originated. But as Stephanie said, from a correspondent perspective, we're benefited because those deals that are out there that are strong and that have lead banks that are wanting to service those, we're able to identify those kind of cream of the crop loans, be able to bring those in and sub-participate them to other banks that are looking for good, strong credits because they do have some liquidity, and be able to provide them that as a way to fund those assets. But it will be more limited on both banks willing to participate and the opportunities that will be actually brought to our attention as far as new credit opportunities.
Yeah, for sure. You mentioned interest rates. Derek and Paul, you guys both did. Have you seen any kind of evolution in interest rate movement since last quarter or, since the beginning of the year?
Um, well, at the short end of the yield curve, 1 year ago, it was at the 1 month T bill was yielding just over 1%. And last night it was marked at 5.1%. So a 400 basis point move at the short end of the curve is something we haven't seen for a generation. Interestingly, on the long end of the curve, at the 10-year mark, a year ago, the 10-year bond was yielding just about 3.1%, and now it's at 3.7. So the curve went from a normally steep yield curve to a significantly inverted yield curve over the course of a year. As I think we mentioned last quarter, inverted yield curves have forecasted or portended recession, but have had a lot of false positives too. So it's a conundrum that even the central bankers were talking about yesterday at their meeting in Portugal, where uh, rates have increased across these different economies 400 or 500 basis points, and it has not slowed down economic activity. And from a macro perspective, employment's still strong, and it's a head scratcher. So there's an article in Bloomberg this morning about Powell, and that he's not talking about data driven at this point. He's talking about maybe judgment because the models aren't behaving the way they expected them to.
One of the things too that we kind of have to look at when you look at the Fed's posture on interest rates and how they are pretty bullish on monitoring inflation. You kind of look at how the market is reacting to it, and as Paul kind of described, the rates have actually bumped up even out to the 5 year on the 5 year term. So I think there's a little bit less expectation to have immediate rate reductions. Where I think a lot of people thought we were going to kind of hit this massive increase in interest rates. We're going to kind of hit this peak, and then there was going to have to be a reactionary reduction in order to maintain stabilization and try to soften any economic downturn. But the economy's been very bullish, and consumer confidence and spending and employment also remain strong. So I think as long as inflation is ticking above 3%, all those other metrics are kind of in line, we may not see additional rate hikes. But I think the expectation to start seeing rate reductions as early as the fourth quarter, as some projections were showing, even following the May meeting of the Board of Governors, it's starting to be kind of squashed as like it's not going to happen. But there's a likelihood that it could happen first quarter of next year now. So it's like so the timeline on these interest rates, I think people need to get kind of accustomed to this rate environment we live in today. Maybe the rate environment we have to live in for the next year or 2 years in foreseeable future. I don't ever see there being 25 basis points Fed rates, um, just as long as the economy stays as bullish as it is right now.
Right. And do you think the key factor of, the interest rate hikes is kind of quelling inflation, or are there more factors at play there?
I think that's job number one. The Fed has a dual mandate of a stable currency and full employment. So the full employment statistic is a funny one too because the participation rate really decreased a lot as a result of COVID response. And there's a chart that we use in our client meetings that said, "Where did everybody go?" And there's some people long COVID, some people figured out it was more economically sound to stay home and take care of the kids instead of working, paying taxes, and then paying for childcare. So all kinds of reasons. Um, but we're short, I think, in aggregate about 3 million employees that we would have had in the United States had immigration policy not been changed during the last presidential administration. So that accounts for a bunch of it. And then if you have really a service-based economy with not a lot of people to provide those services, then they're going to be able to demand more pay. So I think that's where some of the inflation is. The source of it is coming from, and so you've got full employment or even more than full employment right now because I think there's almost two jobs available for every job applicant. Uh, so it's really full employment situation, and you've got that covered. But then the inflation is still clicking above 4%, which is twice the Fed's target. So the interest rate increases of the Fed funds rate have really been focused on quashing inflation.
Yeah, and I think when you look at that, Paul, too, some of those prolonged impacts of COVID and the disruption and the availability of inventory and the just-in-time inventory kind of system that our economy has ran on for so many years, and kind of that change in sentiment of moving more manufacturing to the states and holding more inventory, I think is also going to push up cost because obviously instead of being able to go out and find the lowest cost provider for inventory and go overseas to and just do just in time ordering, that disruption to be able to have the availability some of these key sources of inventory that these companies needed, trying to onboard or at least pre-order and have a kind of a buffer in that inventory, I think as well, just drives up costs. So I think you know there's so many factors that are driving inflation, and you start throwing in bird flu and that's the price of eggs. It's just and then, the cost of the fuel and oil and the impact it has industry wide. I think there's just a lot of factors right now that are still in play, and until the stabilization of what our new economy is going to be, and I think that's kind of the post-COVID world. Where are we at today? And is any of those people that transition to stay at home going to start to feel pressure now that the liquidity is gone to not have maybe the savings account buffer that they had to stay home and take care of the kids? Now they need to get back into the workforce, or as their kids age out and don't need the high cost healthcare or childcare, now they're able to go into a school system where now the parent can be out of the house to work. It's like, are we going to see a big influx of people coming back into the workforce, which would obviously start to increase unemployment numbers as you have more people trying to apply for jobs, and those current job openings are filled. So I'm really cautious in trying to determine if the Fed increases are actually going to have a significant impact on inflation because it's not really being driven by loan rates and loan movement. It's really being driven by all these other factors that are kind of messing with the supply and demand within the economy in these certain segments. It's really driving that up.
Yeah, I feel like you've answered the question that I hear all the time on kind of a consumer side is why is everything so expensive? So we could almost cut it off right here and just have the podcast title be that.
I think I guess this goes back to uh, theory of GDP is, it's a function of how many people are working and how productive they are. And so that GDP growth ought to, I think, follow along with the growth in the currency. But with all the stimulus that occurred as a result of the COVID response, cash was forced into the system, like Derek was mentioning, back in 2020 and rolled into 2021 in terms of excess liquidity. When you have more currency in the system and less productivity, then you have inflation. So it seems like a cause and effect that the government intervened, and now the Fed is trying to mitigate.
Right. So when you have higher interest rates like this and inflation, that obviously comes with some risk for community banks. And this may be more of a Stephanie question, but I know you guys mentioned rate shocks. Is that the main way that community banks can minimize their risk on the lending side, or are there some other things that they could possibly do?
There is something to consider. A lot of large projects get underway a couple of years in advance. And what happens is, a couple years pass, and they've been gathering their investors and putting together this giant project, and time elapses. And by the time they get ready to actually go to a bank and borrow money, all of their projections have been thrown out the window because now the rates are higher than they thought they were going to be in the beginning. And now maybe the project isn't as affordable as they thought it was before. And I've seen that occur a couple of times in some of the bigger projects we look at. So the biggest risk I think right now is if your credit underwriting is not paying attention to your appraisals, your cap rates, what projections really do look like. Are they something that is I would say manageable by the borrower? And future pro formas, are are they tangible? Can you actually reach that pro forma that you've already predicted based on what rates might do? And I really think that everybody that's analyzing these credits, all these lenders, they really need to keep that in mind, that our borrowers may not be able to do what they assumed they were going to be able to do, and you need to be able to step up and kind of put the brakes on and think that through with them, so that you're not putting yourself in at risk down the road when your borrower all of a sudden can't pay because their performance didn't work out the way they thought they did. But that's one of the biggest things that I wanted to make sure I mentioned today, is to pay attention to a project that's been in the works for a couple of years, that's come around, and all of a sudden we're ready to close on this deal, but a lot of things have changed, and it can change in just a few months. They made prepared their performance 3 months ago. Today those performers are completely different than they were 3 months ago.
Yeah, and to impact that as well, the inflation, the cost of materials, cost of labor. Some of these projects, when they first start off, they go through the construction budget and they have their timelines on completion, and then all of a sudden they start the process and they're having to wait 6 months for utilities for multifamily development, or they can't find enough workforce to come in and do drywall work or electrical work, so now they're having to pay a higher premium to attract these different individuals to come in and fulfill these parts of the construction process, or the construction project is delayed. So we've seen a lot of things that have kind of impacted, especially construction and development type projects. And then just a shift in dynamics of working remotely and working from home, and what kind of impact that's going to have on, the commercial real estate, industry as a whole. When you start to look at the amount of vacant office space that's sitting in some of these major MSAs, that maybe a building has 100,000 square feet of office space, it's 100% leased to a company, and it's completely vacant right now because all their employees are remote. but they're still meeting the obligations of their lease agreements. Well, when that lease comes up for expiration renewal, it's unlikely that they're going to be renewed. So if you have existing loans or paying as agreed, it's a great opportunity right now to look at them and say, what do you have that is reliant on, your traditional retail service front, single purpose type facilities, and you start to look at office space specifically. Where are those at? And it's like, even though you're being paid as agreed and your customer has a lease agreement in place with a Fortune 500 company to occupy 100% of that facility, are they actually occupying it? You drive by it and it's like it's nice and manicured, but there's nobody in the building except for a security officer. I would be having some major concerns of whether or not that lease is going to be in place or in play whenever it comes to maturity, and understanding how that lease agreement's structured and making sure your terms align with those lease agreements so that you're not stuck in a 10-year term on a 5-year lease. So there's a lot of things that I think that, when you look at it from a credit perspective and the changes in the economy, rates are one thing, but the impact on inflation, the impact of the supply chain for, construction materials, labor, all those things are going to have an impact on real estate type projects. And then on CNI projects, we need to look at how our CNI customers that are going out providing a service industry, how are they mitigating the increased probably costs in their labor force? If they're going to have to hire, if you have a hotel in a great location that has great occupancy and the market says, hey, there's demand here, but they can't hire service people to clean the rooms and get turns, or have people even work the front desk, are they going to be able to operate effectively? And are they even going to be able to, if it's a construction project, get enough staff to be able to get the flag that they were promised and meet the requirements that Marriott or Hyatt or a large hotel chain is required for them to have in place when they actually open the doors. So there's so many things that need to now be kind of part of that conversation we're having with our borrowers about, how is this project going to work? What are you going to do about these things that we're seeing? Having a good understanding of your market and what's available there. If I was a community banker, I'd be, working with people that I have a great connection with, that I understand how they operate. They have a great business plan. They understand the market. If you're going out and you're doing stuff out in West, and it looks like a great project on its face, if you don't have firsthand knowledge of what's going on in the MSA, or you don't have a direct connection with those guarantors and borrowers and the principals on those credits, I would tread very lightly or dig very deeply, and not just shock interest rates or just look at potential, higher occupancies if a recession occurs, but look at how are they going to manage this project, or how are they going to overcome these things that I know is going on in that market that could impact their employment opportunity or their supply chain or whatever it might be.
Yeah, I think that's really good advice. I think that'll be really helpful for our community banks. Stephanie, you mentioned, pro formas changing within even 3 months and being completely different, which I think is kind of telling of where we're at just economically and with lending right now. So, how have you guys seen the lending landscape change over the last quarter? I mean, has it changed? Have there been significant changes, or has it held steady in the direction we're going?
Well, as far as the amount of loans out there in the market to be had, I believe that they still exist. They're still out there. The issue now is just in the underwriting and trying to be able to consider every possible scenario. We've seen so much happen in the last 3 years, whether it be, like Derek said, the not being able to find employees because they can stay home now. And then when you do find them, you have to pay a lot more to keep them. Or the supply and demand is delaying your projects, things like that. You have to kind of consider everything we've run into when you're looking at every single loan. Even like you said, we might know these guarantors really well, but have they considered some of these things we've seen in other projects that they haven't encountered yet, but they were very well could. So I think that the biggest thing right now is just to stay, you know, follow the 5 C's of credit and go through the process like you're supposed to, and try not to be too lenient in different ways. Make sure you're staying strong and going through those going through the underwriting in the manner that's going to protect your bank. And it protects the borrower. You have to think of it that way too. You're just going to lend this money to this borrower, and you can tell up front that this project may not work, but you go through it anyway, and that could end up ruining that borrower's life sometimes. So if you have a concern, it may be something that the borrower hadn't considered, and if you bring it up and it's something that we should talk through, you can have them adjust their project style, or maybe this project's not going to work at all, especially not for your bank. And if you can't make it work for your bank, you just need to turn them away.
Yeah, absolutely. Are there types of loan or credit products that are more in demand right now than others?
Yeah, well, I mean, we're still seeing a lot of multifamily. That kind of came out of the pandemic, where everybody was spending so much money, and coming into these larger MSAs and wanting to move there, and the multifamily projects have just expanded across the board in the last 3 years. And every time I turn around, I'm seeing another multifamily project coming in, and we're looking at feasibility studies and appraisals that say, yes, we need this. We need a place for people to live. There are some industries that are coming into those markets as well that didn't exist before, that are going to require additional staffing. And so where are those people going to live? And I'm dealing with that in several different markets myself. And it come to find out, all of these multifamily projects are definitely legit, and they're needed in the areas they're coming through. I'm not seeing a lot of other types of commercial real estate. Nashville area, we see a few Airbnbs, but they're still sort of like the multifamily. They're still multiple units or mixed use with some retail or a restaurant involved. So the Nashville area is just a little bit different, but this multifamily stuff is all over the place.
Are these multifamily like investment properties that someone is buying to rent out, or is
Yes.
someone yeah, okay.
Yeah. So and
That's kinda what I
and
thought.
there's different ways to go about these multifamily projects. Some investors go in to build it and sell it, and make money on it. And then others want to build it and keep it and rent it out. And when I said earlier about the pro formas, that comes into play on these as well, because your borrower may anticipate a certain amount for rent per square foot. And your appraiser may say, yes, that's going to work, or no, that's not. And that's where you have to go and really look into, where, like Derek said, know your area and understand where this project is going. Can that actual town produce enough people in it to rent these apartments for that amount of money, or are you overestimating, and which is going to put you in a bind later? And if you started thinking about this project 2 years ago when you were looking at three and a quarter percent rates, and now you're looking at eight and a quarter, can you still survive if you can't get the rents that you thought you were going to be able to get, because everybody had money at one time, and now the money's kind of depleted? Can they pay that rent? Something to consider every time we're underwriting a new project at all. Can the consumer still afford what you're trying to give them?
Yeah, that's a really good point. Have you seen regulatory changes, especially coming out of the pandemic, that are influencing lending practices?
Not necessarily changes, but maybe higher scrutiny in certain areas. Um, Concentrations is a big thing for these examiners to look at when they walk into banks today, because there was so much loan demand, and we've been able to uh, you know, grow our loans so big. A lot of our banks have been able to grow their loans, and then we pile something up in a certain category. And have you really been underwriting those well enough to have such a concentration in that particular category, such as multifamily? You put a bunch of multifamily loans on the books, and all of a sudden you're at 100% of your capital. And if multifamily market drops, then what are you going to do with those loans? Every one of them is going to go bad. So if you're approaching a concentration in any type of category or industry, that is going to be looked at heavily by the examiners when they walk into your bank. And you're going to want to start really thinking about, where do you need to cut yourself off? Where do you need to stop lending in that area? Or if you do want to continue to lend because you have the borrowers that need the money, you can, look into the participation side of things, participating them out if you can't hold them on your books. And I think that that's a an advantage of a banker's bank, of course, is we do have that ability to participate loans out and only keep what we, want to keep on our books to manage our concentrations in specific market areas or in specific industries or categories.
Yeah, absolutely. I'm glad you threw in the advantage of Banker's Bank, little ICBB plug there. So, other than what we've mentioned, are there any other big challenges or risks that are facing lenders in our market right now?
One of the things that I mean, we all need to dig into is during this pandemic, did we put a bunch of loans on our books at a fixed rate below 5%? We've got three and a quarter, 3.4, we've got 4%. When we did those loans, we put them on our books at a fixed rate. And now here we're looking at paying our depositors 5% or higher. What does that do to the bottom line for the bank? And I think that a lot of the banks that, were bound and determined to give they wanted to win the loan. So they gave the best rate they could, not necessarily considering what could happen to the interest rates down the road. And now you're sitting with a bunch of loans on your books at below market rates that are never going to change. Um, and if the loan demand slows and you're not putting on new loans at these higher rates that are out there, your cost of funds is astronomical, and now you're just not making the money back up to pay those interest rates out on your depositors. And the depositors is what you need today. You need those deposits to come into your bank, and in order to get them, you got to pay for them because the bank down the road is going to be competing for the exact same deposit you're competing for. And so I think that everybody should probably take a look at their loan portfolio and kind of take a glance at what the variable rates look like in in their own portfolio. Do you have a lot of things sitting there at a fixed rate that, nothing's going to happen to them? Or do you have a lot of variable rate loans? And if you do have a lot of variable rate loans, and they're maybe, so say you never put a ceiling in them and these rates are about to change and they're going to increase really high, what does that do to the repayment capacity of that borrower? If those rates went up 4% since the time even 5% since the time you put them on the books, and of course their pro formas were perfect at a 3.25%, and even if you shocked it up to about 5.25, now we're hitting 8, are they still able to pay? I think you need to be ahead of the game when it comes to looking at these variable rates as they come to you and towards you, to make sure that the cash flows are available to actually pay that debt back to the bank at that new rate. And I think Paul said earlier, maybe some concessions would have to go into play when you're dealing with some of those borrowers that didn't plan for this, or you didn't even plan for this, and now they're not able to make the money they wanted to make on that project. Now they can't pay the project.
It seems like that's the headline and the takeaway from the past 3 years in credit and lending. Be ahead of the game. Expect literally anything.
Yes.
And one of the things that kind of to build off of that too is, like, everybody kind of focuses because interest rates are the things that's talked about. You see an increase in interest rates and the impact it has on borrowing cost. And the deeper thing is that a lot of these projects that, are commercial real estate projects and develops on the multifamily, hospitality, mixed use facilities that we've seen developed over the last several years. As these projects were being built out, those investors that were coming to those projects were expecting a certain amount of return. And as a bank, we were saying, okay, if they feel like they're getting enough return on this investment and it cash flows based off of this, structure, even with a shock, if it still was to cash flow, then the concern becomes, well, at some point in time, you have that tertiary or third option of repayment. So first, you're looking at the project and the cash flow from it. Then you're looking at those guarantors and their liquidity, and then you're ultimately going to be looking at the liquidation of the asset itself. Well, the cash flow we now is going to be constrained. So our primary source of repayment on almost every single credit that we're underwriting is the cash flow. Well, if the cash flow is now constrained because of higher interest rate cost, higher cost of operations, lower net interest margin, or net operating income, excuse me. Now our first option we know is under distress. So what's the second option? Liquidity in our borrowers. What have we just seen? We've seen this massive outflux of liquidity. We saw this big influx of liquidity. So we had these guarantors and these borrowers and customers sitting there with a massive amount of liquidity sitting there as reserve. Well, if they're experiencing the same ratio of liquidity contraction that the banks are seeing and everybody else is seeing in the marketplace, then we can expect there to be a similar contraction on a lot of our guarantors, and we need to assess that and verify that liquidity and make sure that they had $5 million in liquidity when we booked this deal. Do they still have 5 million, or is it now 4 or 3 or 1, or is it gone? Now, if we start to see that that liquidity constraint is causing our secondary source of repayment to be basically wiped out, then we go to the tertiary, the third option. Okay, we did an appraisal on the front end. What was the cap rate on that appraisal? Was it 4.5%? And that 4.5% give us a nice, comfortable 75% loan to value. Well, if now current market rates are 8.5%, and I want to sell that property to a new investor that's going to look at what kind of return they need to receive on that property in order for them to want to invest in it, they're going to have to see that they're going to have cash flow that's more constrained than what the original appraisal had, because obviously it's not cash flowing and performing like it originally said it was going to. That's why it's in default. So now let's look at the cap rate. Now the cap rate's gone from 4% to 8%. So a property that may have appraised for $10 million based off a net income and a cap rate of 4% 4 or 5 years ago, if now the cap rate's say 6.5, 7%, and your net operating income from that project's 75% is what it was expected, you can see appraisals that are coming in at 50% of what the original appraisal just 3, 4, 5 years ago on that same project came in at from an income perspective. And as banks, we need to look at that and be very assured that our tertiary source repayment still exists. Because if we allow the secondary source and we allow that liquidity to go away, and all we're left with is real estate that's maybe worth 20 to 30% less from an appraised value as it was when that deal was originally done, we may not even have a true protected third position. So I think as we start doing our portfolio analysis of these deals, we need to be looking at not just cash flow and impact and shock on the interest rates, really need to be looking at the liquidity of those guarantors and getting some verified liquidity. Where are they at today, and how has that changed over time? So then I look at it and say, hey, it's still sufficient. Well, it may still be sufficient, but it's half of what it was 2 years ago. Okay, well, if it's half of what it was 2 years ago, where's it going over the next 2 years when this thing gets ready to balloon or gets ready to reprice? And then start looking at that property itself. Start looking at cap rates. If you get another appraisal that are coming in, what did the original appraisal say the cap rate is, and what's your newest appraisal in that market saying the cap rate is today? What's the net operating income of that project today versus what you had received in the performance and what was used in the appraisal, and do a revaluation to say how is the value of that property change and what's that put you at as far as a loan to value today. So everything that's happened is these unintended consequences of these big influx of liquidity, near zero interest rates for such a long period of time. Everybody got very comfortable with near zero. You had this big influx of liquidity, people needed some place to put it. And then all of a sudden now we're looking at it, the liquidity is gone and interest rates are back to what I would consider to be historically normal, but it's not near zero. So nobody's like accustomed or prepared for what the overall unintended consequences it's going to have and the collateral damage it's going to create on everything that we used as our underwriting matrix in 2019 prior to now in 2023 going forward. We're going to have to go back and reset and say, all right, this verified liquidity and liquidity requirements need to be a covenant that we actually monitor and track and make sure that we hold accountable, because we can't rely on the tertiary to still be in existence with all the different matrices that have changed within the economy.
That's a great point. The verification of liquidity is something that banks have kind of, you know, stopped doing a lot of times. I noticed some of the credits I receive that I have to underwrite. We're sitting here looking at personal financial statements that say they have $5 million, but do they really? And if they do, where is that $5 million? And we have to go back to our banks and say, we need verification of this liquidity to prove that it's there, and it's not only going to go into this project, but help back the project up down the road.
Yeah, for sure. So you mentioned that, and you mentioned, some tightening. So are the credit scoring models and risk assessments themselves changing, or is it just that community banks are, scrutinizing more, kind of tightening up and kind of bringing back some things that have fallen by the wayside in their credit practices?
Yeah, that's what that's exactly what's happened. The falling by the wayside. You got comfortable with during the pandemic, how you were underwriting your loans and things. But your first question there is has the scoring models changed or assessments changed? And if you're doing your job right, it shouldn't have. You should still be doing everything the same when you're underwriting a credit. If you do it right to begin with, then you don't relax and you don't get too harsh. You're just always doing it the same way. And we have to deal with so many respondent banks on a daily basis that everybody does things a little bit differently. So I feel like that the Bankers Bank comes in and would try to keep everything status quo. It's actually looking at these credits the way you should be looking at them and always doing that, whether it's a pandemic or not a pandemic, low interest rates or high interest rates. Do it right the first time. And then, everybody has losses at some point. Not everybody can succeed. But if you do your best in the front end at underwriting it the way you should, then you're going to be a little bit better off in the end.
Yeah, that makes a lot of sense. And we touched on this earlier, but on the lender side and the consumer side, are there any big shifts, especially over the past quarter, in consumer behavior or in borrowing habits that lenders need to be aware of? I know the obvious one. I was at a bank marketing directors forum yesterday, and somebody was saying like, "Oh, our mortgage people are, putting pressure on our marketing team to, advertise mortgages because nobody's coming in for mortgages." Well, they're not coming in for mortgages because the rates are so high. Um, but yeah, that is to say, are there any shifts in consumer behaviors that lenders kind of need to be aware of going into Q3?
Say the multifamily information I was sharing earlier, that plays into this extremely well. People are not able to afford mortgages now because the interest rates are so high. And now you might have a one income family because during the pandemic you thought, we're better off staying home, not sending the kids to daycare or whatever, and we can make it just fine. And now all of a sudden, if you need to buy a house, you can't afford it because of the rate. So what are you doing? You're moving into apartments. So multifamily projects keep popping up. And that's going to support a lot of this, not able to afford a mortgage going forward with the interest rates the way they are today. I'm not saying that's not going to pop back and it'd be fine, and people start going back into the job market and having two income families again. But those multifamily projects are going to, succeed well when the mortgages are low. When nobody's out there getting mortgages, that's when multifamily comes into play.
I just say, Madison, some statistics we've seen lately with respect to debt service ratio for households ticked up from a low of about 8.5 um, during the pandemic to close to 10% right now. Back in '06, when it was the wild west of mortgage loan underwriting, if you can call it that, you were at about 13. Uh, Revolving consumer credit outstanding is at an all-time high of about 1.2 trillion, and credit card loans and automotive loan delinquencies have uh, clicked up in the roughly 6% range. So the consumer, this just ties right into the lack of liquidity. The consumer has spent the stimulus money. There's inflation as a result of, in part, as a result of the stimulus money, and now those dollars are being spent, and and then people are on their credit card balances and their equity lines and so forth.
Yeah, that's a good point, and that makes a lot of sense with what I've been, seeing and experiencing as a consumer. Uh, so to kind of wrap all of this up, if each of you could give one piece of advice to our community bankers as we head into Q3, what would that be?
I think one thing that Derek made a good point earlier about the cap rates. And this is something I've been thinking about a lot lately, and I need to dig into it a little bit more. But um, all these loans that you've had on your books all this time, and when you put them on the books, everything was great, hunky dory, and your appraisals were all fine. But now these projects are constructed, or they're up and stabilized. Going back and looking at all of those loans and comparing to their net operating income today to what you thought it was going to be, and what the value of your asset is today. If you have lost value because of these increased rates and things like that, what are you going to do? You know, you need to think about that. What are we going to do about all of these assets we have in our books that are not worth what we have them on the books for? And kind of try to get a plan together, I think.
With respect to community banks, one word or one piece of advice. The last quarter I said discipline, and this quarter I will repeat that, but I would add another word, which is a real focus on non-interest income, and that's a real differentiator among banks. As we know, cash is just a commodity, but to the extent that a community bank can engender profitable relationships that really help customers and help the communities where they live, that can be a really good business model. And some of those the ways to go about that is to actually provide advisory services in house or through partnerships. Uh, so yeah, non-interest income when it comes to an exit valuation, if a family is interested in selling a community bank, can really be a differentiator in the valuation multiple too.
If I had to give one piece of advice to bankers and really just anybody in general, and what I've kind of, from my experience since taking over as president and CEO of the bank and kind of experience over the last several years, is kind of expect the unexpected. I think that we get comfortable looking at historical trends to try to determine future events, and unfortunately, the past is not a prediction of the future, and that's been very apparent in what's happened over the 2020, 21, 22, and what we're seeing and experiencing here in 23 is, there are metrics out there that we can use to kind of give us some kind of comfort and indications and where we are kind of trending towards. But there's some factors now that I don't think that our economy has ever experienced, that are new. And I think this change and shift in dynamics, even with the generational shift to the millennials now being, the core of our workforce, and you have the Gen Alphas and those getting ready to come of age and going to college and starting to kind of enter in the workforce, and what their expectations and their focus and stuff is going to be. Uh, as a lender, you have to just basically look at it from the perspective of, and as a banker, what is it that I know, and how can I make sure that I stay within my policies, and try to avoid policy exceptions as much as possible. And we are competitive nature as human beings, especially if you're a lender. I was a lender for years, and there was nothing better than beating out somebody else in a loan deal, that you knew was a great credit and you wanted to have it, and you wanted to go stick your sign up in that building saying financed by my bank. You wanted to be there for the ribbon cutting and get to tell everybody about how you were involved in it. I mean, there is a personal drive to want to win, and sometimes we just need to make sure we take a step back and say, hey, are we winning the right deals? Are we doing the right things to make sure that not only are we getting to stamp our flag, but we also get the ability to do what's best for our institution. And ultimately, if we do it and we do it in the right way, we're doing the best thing for our customer. If our customers are going into a deal just looking at it from the perspective of what they see as a developer or whatever it might be, and just a silent investor, whatever it is, that they are going to be limited in their understanding of credit and risk to them, and how their equity investment in a project that all of a sudden becomes underwater when it comes to evaluation doesn't give them the ability to just get out of this deal themselves. At some point in the future, they need liquidity, or if they want to exit that project. Well, if that project ain't worth what it was when you invested in it, you're not going to be able to exit that the way you thought you could when you originally entered it. Well, if we do the right thing as bankers and we're informing our customers, like, listen, here's the concerns that we see, we may be shedding light on these projects for our investors and for those borrowers that they're not perceiving. And ultimately, they're going to make the decision. Now, whether it's with us or another bank, if it goes south, whoever's holding that credit and they have to do the workout with that borrower and go through the liquidation process and all that stuff like that, and have to manage that asset through its troubled times, is going to be the bad guy. So no matter how good the credit looks on the front end, you need to be really assured that you're at least communicating and going through all the mitigations and all the concerns, risks that you have with your board, with your loan committee or board or officer committee or whoever's making that approval, and communicating it directly with your lenders, with your borrowers as well. Like, hey, listen, we're looking at this. Here's what we're kind of seeing. Are you guys okay with this? Are you? And have those conversations. And if they don't want to answer it, like, I just need to get this deal done. Well, you may want to take a step back and say, have they really evaluated this deal and do they understand the risk they're taking? And am I okay taking on that risk because they're not willing to even look at it? So there's a lot of different things that we need to do as bankers to kind of make sure if we're going to be a community banker, we need to be willing to have the tough conversations with our customers and tell them sometimes the things they don't really want to hear. We kind of joked when I came on here. I told him Paul called me doctor because I said that I got behind on my first appointment, been running late for everything else for the rest of the day. Well, your doctor always has to tell you the tough things. You don't want to hear it. So we try to avoid the doctor until something's wrong. And then we want him to be frank with us and tell us exactly what's wrong. Well, as lenders, we got to kind of think about it like that. When they come into us, they're looking at us because we are the financial experts. We're the ones that are advising them on what we perceive as risk. And we're trying to do everything we can to mitigate it because that's not our business. Our business isn't to take on risk, it's to help facilitate projects that the borrower is willing to accept the risk on. And we have to communicate that in a way of saying, like, listen, here's what's changing. And I can't expect interest rates to go down. So when I'm sitting here looking at it today and say, yeah, man, this is a really tight cash flow, but these interest rates aren't going to hold. Well, in my experience, the interest rates are probably going to go up, because whatever I expect or think in this economy and the world that I've lived in over the last 4 years, I almost want to say I'm going to expect something awful. So hopefully something good will happen. So as lenders, we need to start putting it on there and say, like, listen, okay, it works today, but what happens? Let's run some scenarios and let's stress these deals to figure out where the pain points are at and have that hard conversation with our customer to say, like, listen, we can't do a 30-year amortization because I have no idea what's going to happen in the next 5 to 10 years. And I don't want to be carrying a credit that still has 65 to 70% of the credit risk to me because the amortization is so long. So you got to start to look at it from a different perspective of, I just want to win the deal. Say, I want to win the deals that make sense for me. And I'm going to communicate to my customer in a way that they're willing to accept the risk. And we put it in a position where we know we can recover.
Yeah, for sure. That makes sense. I think that's all really great advice for our community banks and their lenders. I want to thank you guys for joining today. You guys have said a lot of really great things that I think are going to be really valuable to our listeners. And I'm just glad you're willing to join the Q2 Market podcast. So thank you guys.
Thank you, Madison.
Thank you, Madison.
Thank you.
Thanks, Madison.
Thank you guys so much for listening, and I hope you've gotten some value from this conversation to take back to your community bank. Make sure to follow or subscribe to The Correspondent wherever you get your podcasts and turn on notifications so you never miss a new episode. See you next time.